We all exit our company eventually. The question is, will it be on your terms or someone else's? Strategy matters. Timing matters. The right partner changes everything. Brought to you by Meritage Partners. Here is your host, Brian Franco, author of The Inevitable Exit. This is the M&A Guy podcast.
I'm Brian Franco, and I'm running a special episode today with you on the M&A Guy podcast. I have not done a solo podcast in quite some time, and it's something I've been wanting to do in, spending that time with you. So if you've been tuned in over the years and listened to the conversations that we've had and the guests that we've had, it's really been around preparing your business for a capital event. And that capital event could be for growth capital, or it could be for preparing for an exit. That exit can sometimes be 100% of your company being sold, or sometimes, and a lot of times, it ends up being a sale of majority of your business, which then you participate with the capital partners and the new partners going forward. So I want to dive into that because this is all made possible by what I'm calling the great equalizer. And the great equalizer is this. It's the secret weapon in Main Street businesses. And I call it that because M&A became Main Street's secret weapon. Mergers and acquisitions. For years and years and years, you had companies throughout America, throughout the world, that had no options to liquidity. And in the 80s and in the 90s, what was popular then was sale instruments or vehicles like ESOPs, employee stock ownership programs, where an ownership or a group of owners or single owner would sell their business when they came to a retirement age back to their employees. And it was very popular, worked well, provided liquidity and a pathway for those owners to retire. But as time advanced and progressed, what we saw in the late 90s and early 2000s, the rise of private equity. Everyone's talking about private equity. But what is that? How does it work? And how does it become the great force of equalization for Main Street companies? Because like public companies in the markets, they have liquidity to the public markets, where privately held businesses do not unless they go public. And so when you think about the private capital markets and the potential of selling part or all of your company, you've now been given the same tools, the same resources, and the same options that larger publicly traded companies have, and that's liquidity. The differentiation mainly that we see on a day-to-day is companies, privately held companies, they don't have real-time data. They're not running audited reports on a frequent basis like monthly or quarterly. At best, privately held companies are doing that on an annual basis, but usually not by their own doing. It's usually because they have a reason to do it beyond operating the business, such as they may have a debt lender or they may have government contracts that require them to have audits. And so what are audits? Audits of your financials are verification of the revenues and the profit that you're generating. And those are important for the private capital markets and those investing into Main Street companies in the private capital markets, because that is the proof that they go to their lenders and their LPs and GPs with to raise capital to acquire your companies. So let's dive in, because the great equalizer is the opportunity we've all been waiting for. And it's here and it's been here. And I want to guide you and talk you through, how do you show up? How do you prepare? And more importantly, what are you preparing for? And I'd like to talk about and provoke a question in you. And that is, if you're looking to exit, great, we're here for you. Book a discovery call. Meritage Partners will guide you, lead you, and execute on that strategy. But my question is, what are you exiting into? And so when you're exiting into something, you're leaving or exiting something you no longer want to do. And I want you to think about that. Ask yourself that question, because this is going to drive a lot of the motivation in the direction that we're going to talk about and the actionable advice that I'm going to give you. So let's dive in. If you're running a business that has real revenue, and I say real revenue, everyone has real revenue. But what I'm talking about is companies with 5, 10, 50, 80, 100, $150 million of revenue. It doesn't matter if you made it by most people's standards or even by your own. What I'm talking about is critical mass. Do you have the critical mass in your business? And I give you that wide range of revenues because it depends on your industry. If you're a software company doing $5 million of revenue a year, you have reached that critical mass. If you are a manufacturing company or distribution company or a professional services company with $5 million of revenue, The perception may be that you have not reached that critical mass just because your revenues are typically project-based and not reoccurring revenue, such as a software business. So let's dive in, because there's a shift happening right now in how wealth is getting built in this country. And if you don't understand it, you're not going to have the opportunity to access it. Even worse, you're going to leave money on the table. Could be a little, could be a lot, but you're not going to know unless you are clear on what your business is worth, who's willing to pay you the highest and best valuation for that business. And even if valuation is not your driver, maybe it's legacy and continuity, there are still ways in which you can determine who the right partner is for your business. And I want to walk you through this great equalizer. I broke it into a few segments here. And the first one is really, let's validate what I'm talking about. Numbers matter. Numbers make sense. We all associate and can give our attention to numbers. So let's talk about that. In 2001, the global M&A market hit $5.8 trillion across 62,000 transactions. Each transaction represented a company. Now, private equity alone accounted for over $1 trillion of that 5.8 trillion. More money has moved through business deals that year than the GDP of most countries. Think about that. More money that year than the GDP of most countries. For decades, M&A was reserved for the Fortune 500 companies. If you weren't running a billion-dollar company, you didn't get a seat at the table. But that's changed. More money moved through deals last year than the GDP of most countries. You have to pay attention to that, because this is your exit strategy. This is your exit route, whatever that may be. And I'm going to break it down even further. Now that you see the size and the mass and the amount of money that's being invested, let's not forget the $10 trillion of estimated value in businesses that is intended to transfer hands from one generation to the next. And what we're seeing is that the second generation within a family is not the ones that are accessing those assets. Or I should say, they're not wanting to own those assets. Of course, they want to access the liquidity. But how do we get there? So this is why this moment matters. The cost of waiting is extreme. And let me quantify that for you. So I need to tell you about the other side of this. The entrepreneurs who do not make it, it's not because they failed. It's not because they ran out of time before they capture the value that they built. I want to talk to you about a client case study. He was an owner of an engineering firm and never ever brought anyone else onto the cap table, onto the ownership table. He had the ability to have hundreds of employees without ever gifting, or allowing anyone to earn equity in the business. And he came to retirement age and he realized that the very people that he had brought up in the organization and the people that were running his firm with him were not the same people that could take it over, were not the same people that can sit in his seat and make the decisions that he was making. And so what ended up happening is we got to a point in his life where he was wanting to retire, and we had to come up with a strategy that would not only give him that off-ramp and that roadmap to retirement, but it gave the company the ability to continue as is, where is, with the people that he has worked and invested so hard into. And we had to make sure we did that in a way that allowed the investor to come in and assume those relationships. But the issue there was no one in the organization that he could have brought up into his position. And that is a problem when it comes to M&A transactions, because investors and buyers want to know who's the leaders, who's the remaining leaders after a company is sold. And so what we determined and what we decided was that of those 5 individuals, 3 of them had the ability collectively to replace the owner of our client in the day-to-day operations. And so that became the resolve. We got the transaction completed. We actually sold that business to a publicly traded buyer in the marketplace, and it went very well. I want to share another story with you. This is let's call it a 30-something-year-old owner of an oil lubricant distribution business that he had built with systems, with people, with processes. And that business sat on autopilot, I'll call it, for decades instead of scaling. Now, at the surface, it might sound like this individual, this 30-year-old was, off and neglecting the business and letting it run on autopilot. That was not the case. It was a sad case study of where the owner rode his motorcycle home on a Friday and never came back ever again. He ended up becoming a human vegetable and lived the remainder of his lives in a hospital bed. And the family had come to our firm wanting to position the business to be sold, which we did, and we executed and we closed. When I think back at this case study, I see the amount of potential that this business had and the growth that it could have captured over those years. But look, he was 30 years old. Who's thinking about exit planning and exit strategies and optionality at age 30? Obviously not this particular client in this case study. And we're working very hard to provoke that in all of you that are tuned in and listening to all this content that we put out so that we can educate you and show you and move you in a direction that gives you those options that you deserve and that you need. And even in my own personal situation, those of you who have heard me speaking, we saw personally firsthand my father's business decline with his health until he had to close the doors. And that was hard to watch. It was hard to experience, but that experience didn't go for nothing. It allowed me to see firsthand what happens to a business, to a family's legacy, if it's not carefully managed and if it's not carefully planned out from the standpoint of exit strategies and options. None of these people failed. None of them. They built real businesses. They generated real profit. They had real employees with real legacies. And they were in a situation where their circumstance led them to where they ended up. No one planned for that, but you can. Because look, if one thing that we've learned about life is you can't predict everything, but you could predict that there will be some occurrence along your journey that is not going to be in accordance with your plan. It's not going to be in accordance with your vision. So what do? How do we address this? Where do we start? There's a lot to learn here and there's a lot to unpack, but I just really want you to take away at this moment in time all of the reasons why planning is important. So we talked about the capital in the market. We talked about liquidity. We talked about reasons and case studies of why planning and specifically exit planning was important. But let me talk about why now, because the wall between Wall Street and Main Street has come down. Businesses doing $10 to $50 million plus in revenue are now viewed by sophisticated investors as an asset class of their own. These are called alternative assets. Private equity is sitting on a record amount of what we call dry powder. That's capital raised, not yet deployed. And these private equity investors are looking for businesses exactly in this range, $10 to $50 million of revenue, even beyond, could be 100, 150, $250 million of revenue. 15 years ago, if you owned a car wash, and I love this example, a car wash, because I've invested in a few over the years, and they're great investments. But if you owned a car wash, you always were going to own that car wash unless you sold it to another operator, someone that was willing to show up every day and run that business. But today, private equity is turning car washes into subscription-based, tech-enabled platforms generating hundreds of millions of dollars every single year. Same thing happened in HVAC, in plumbing, fitness, healthcare services, professional services, B2B, B2C services. 15 years ago, a car wash was just a car wash, but not anymore. That car wash is being targeted by investors across the country, and they're aggregating location by location by location, and they're getting to critical mass, and that's their intention. Let me give you a real example of a family-run HVAC company in Tucson, Arizona. Not a glamorous business from the standpoint of blue-collar operations, but the glamour is in the green. It's in the money. The owner partnered with a private equity firm on their first deal. First deal meaning they sold a majority of their business to a private equity partner that came in and ran and scaled that business with them. And 18 months later, revenue went from 30 million to 70 million through strategic acquisitions. Today, that platform has rolled up nearly 800 companies. You heard me right, 800 companies, and generates $2.2 billion in revenue. It still is a privately held company. So a regional HVAC company in Tucson is not a tech company. It's not Silicon Valley. 2.2 billion, that's the new reality of American businesses. From 30 million to $2.2 billion empire. And it started with a local regional HVAC company located in Tucson, Arizona. So how does this happen? How do you go from 30 million of annual revenue to 2.2? Companies with an M&A playbook outperform those without a playbook roughly by 130% per year. So those with a playbook, an M&A playbook, will outperform their competitors by 130% annually. So take two identical companies, same revenue, same margin, same market. 5 years later, the one with an M&A strategy is worth almost 2.3 times more simply because they had that M&A strategy. This isn't about getting bigger for the sake of getting bigger. The rules of wealth creation changed. The owners who see it are builders of empires, and they are building their empires every single day. The ones who don't are going to watch someone else consolidate around them. Remember, these companies are the same revenue, same margins, same market, but one is going to be worth 2.3 times more 5 years later. Which one are you going to be? Right now, you're standing at a choice point. You can keep doing what you're doing, grinding, growing incrementally, that is, telling yourself you'll figure out an exit plan later. Or you can decide today that you are done building a job and you're ready to start building an asset. So ask yourself, are you building this on purpose or is it just happening to you? If you want the framework, how to build enterprise value, how to think like a buyer, how to position your business to be irresistible, that's exactly what we built at empire-builder.com. We'll have some links in the show notes for you, but come build your empire with us. And if you want the full playbook, everything I just walked you through and a lot more, it's all in my book, Inevitable Exit. So grab a copy at inevitableexit.com. And on our next episode, we're going to be getting back to conversations with guests and founders like you that have gone through real exits, discussing real numbers. You're not going to want to miss it. So I look forward to seeing you guys next week. Until then, let this great equalizer become your new motivation for building your empire. Until then, be well. I'll see you soon. I'm Brian Franco, and this is the M&A Guy podcast.